Futures are exchange-traded contracts to buy or sell an asset for a fixed price at a fixed future date. They have predetermined contract sizes and settlement dates, which may not match an organisation's actual exposures. This means that an organisation may be in a position where it cannot completely eliminate its financial risks, as it may need to underhedge or overhedge its exposures. On the flip side, futures contracts are held directly with the futures exchange, which eliminates the counterparty risk. Consider a chocolate manufacturer that wants to lock in a US dollar price to purchase sugar in May. It could buy a sugar futures contract, which is quoted in US dollars per pound, has a contract unit of 112,000 pounds of sugar, and which has settlements taking place every March, May, July, and October. The chocolate manufacturer could buy 2 futures contracts for a total of 224,000 pounds of sugar and lock in a price of 13.5 US cents per pound for a May settlement. This equates to a buy price of 30,240 US dollars. Note that this amount is not paid in full upfront. Only a small margin is required to be deposited with the clearinghouse initially, and this is known as the initial margin. Then, this margin is marked to market daily, meaning that if the sugar futures price falls, the chocolate manufacturer's buy position is losing money. In such situations, it would need to contribute more funds to meet the required margin, and this is known as the variation margin. Alternatively, if the futures price rises, the chocolate manufacturer's buy position gains money, and it has funds in excess of the required margin. These excess funds would be returned to the manufacturer. On settlement, the sugar futures are cash settled, meaning that any differential between the opening position and closing settlement price is settled with the clearinghouse. However, what typically happens in futures trading is that just prior to settlement, the bought futures position is unwound or offset by selling 2 futures contracts for the same delivery date. This closes out the open position, and the chocolate manufacturer simply pays or receives any difference in price between the 2 trades. If the price near settlement was, say, 14 US cents per pound, the chocolate manufacturer would sell its 2 futures contracts and effectively receive from the clearinghouse 0.5 US cents per pound, or 1,120 US dollars. These funds are then used to offset the actual purchase of sugar on the spot market, which would be at the higher price of 14 US cents per pound, bringing the net purchase price back to the original 13.5 US cents per pound. Effectively, the chocolate manufacturer has closely aligned its sale price, volume, and date with the futures contract, reducing its commodity price risk.